if you look at the default rates in China property high yield, over the last 3 years is averaging around 48% each year. So even year to date, we've had a strong rally, but we've also had a lot of defaults. So managing that risk takes quite a bit of careful credit analysis. So if you look at what we've written, we do have an overweight on high yield, but in terms of the tail, much of that tail risk, some of the really high yielding stuff, we do see value, but it requires a lot of very careful credit analysis. So it's one that we think, yes, selectively, there are names out there that could offer, very high returns, but it's one that requires quite a lot of careful analysis as well, simply because the default rates remain very high. And for next year, we think China property high yield defaults will still be elevated at 19.2%. So it's not a straightforward call to be just long because returns are high. There are a lot of risks in the system.
Yeah, returns are high. I mean, yields on some of these names are in the mid double digits or even higher, if I'm not mistaken. So that's obviously the attraction. But you're saying with default rates likely to stay elevated for at least the next year or so. I mean, forget about the risk of mark-to-market losses, right? I mean, in between, before maturity, they could actually go belly up.
If you look at what our China property research team have written on the equity side, they're expecting pricing stabilization towards the end of next year. They're also expecting primary sales to stabilize in 2027. So we're still some distance away in terms of a full recovery for the segment. And in terms of the more distressed side, what we've been writing is that what we need to see is more effort by central government in order to be a little bit more heavy-handed to put in a package to clean up some of the excess inventory in the system. And so far, if you look at the policy easing, we've not seen that. So for us, if we are to be more positive on especially more the distressed side, the lower dollar price bonds, we really would prefer to see policymakers being more active in terms of cleaning up the excess inventory.
Ken, we heard Shamala say a lot of risk has been priced in, but arguably not the risk of Trump tariffs. That is still a very fluid, evolving story, and that could be another shock, and quite a big one, for the Chinese economy. So isn't caution warranted?
From a credit perspective, we actually think the tariff impact is actually relatively small. And you can see that from a couple of angles. So the first angle is, well, let's look back at what happened in 2018 and 19. That's when we last had the trade tensions and the tariff tensions. And you look at back then, actually the bigger impact on the markets was really macro, right, in terms of the Fed moves, the volatility on the equity markets. It was those factors which impacted the market a lot more than the actual tariffs themselves. The second area to look at is, well, what are the direct impact on Chinese credit? And for us, screening through a lot of the Chinese credit names, actually the vast majority of them have very little or zero revenue impact from the United States. The only segment that do have some U.S. revenue impact are the TMT sector. And within that, actually, the vast majority, the bulk of the TMT names are domestic names in China anyway. So we feel as though the tariffs, obviously, it could have headline news and cause some noise, but we do think that the overall impact in terms of China credit is likely to be fairly limited.